Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Sir John Templeton. Now look around. Does this feel like skepticism to you? Or does this feel like your friend who just discovered options trading and thinks he's the next Warren Buffett? Because the market right now feels calm, too calm, and something is quietly changing in 2026.
We've seen this movie before. 1972. The Nifty 50. 50 can't lose stocks. Coca-Cola, Xerox, Polaroid. People said you could buy them at any price because they were the future. Sound familiar? Fast forward. By 1974, the S&P 500 fell nearly 48%. Some of those untouchable stocks dropped 60 to 90%. Not because they were bad companies, but because the price you pay matters. Now let's jump to 1999. Dot-com boom. The NASDAQ was trading at a PE ratio over 100x earnings. Companies with zero profits were worth billions. Everyone thought this time is different. It wasn't. History doesn't repeat, but it absolutely rhymes. And 2026 is starting to rhyme. Let's talk numbers. Right now, the S&P 500 is trading around 24 times earnings. But here's the real twist. The top 7 companies, the so-called Magnificent Seven, now make up roughly 30 to 35% of the entire S&P 500. That's insane concentration. In 2000, the top 5 stocks made up about 18%. Today, 1/3 of the index is basically riding on a handful of tech giants. It's like saying your entire group project depends on that one overachiever. If they burn out, everyone fails. Now add this. U.S. federal debt has crossed $34 trillion. Interest payments alone are over $1 trillion per year. That's more than the U.S. spends on defense. Meanwhile, global central banks bought over 1,000 tons of gold in a single year recently, one of the highest levels in decades. Why? Because when governments start stacking gold, they're preparing for something. And here's the subtle shift in 2026. Liquidity is tightening. The money printer go burr era is cooling. Rates are higher than they were for most of the 2010s. And valuations, still expensive. The market isn't crashing, but it's not cheap either. That's the uncomfortable middle.
So what does this mean for you? It means we're in a fragile equilibrium. AI is real. Productivity gains are real. Corporate profits for big tech are massive, but expectations are even bigger. When a stock trades at 40x earnings, it doesn't need good news. It needs perfect news, and perfection is rare. Right now, investors are acting like someone who just matched with a 10-10 on a dating app. They're ignoring all red flags. High valuation? It's fine. Debt levels? It's fine. Geopolitical risk? It's fine. Until it's not. Something is quietly changing in 2026. Not a crash, not a boom, but a shift. From easy money to expensive money. From blind optimism to selective survival.
Here's the truth. The market isn't screaming, it's whispering. And whispers are more dangerous because most people don't hear them. History says extremes don't last. Valuations matter. Debt matters. Liquidity matters. But so does innovation. So no, this isn't doom. And it's not hype either. It's a reminder. In uncertain times, the winners aren't the loudest bulls or the loudest bears. They're the ones who manage risk. Stay diversified. Question narratives. And think independently. Because when something is quietly changing, the smartest move isn't panic. It's preparation.